Ever heard of Charles or Chase Coleman Jr. III Esquire? Maybe not. He's not all that well known. But don't let this low-key New Yorker's lack of notoriety fool you. The 45-year-old runs one of the world's biggest hedge funds, Tiger Global Management Limited, with assets under management of $35.5 billion as of the firm's most recent SEC filing. He was one of the early investors in Facebook and, according to rumor, transformed initial startup capital of $25 million into a $6 billion fortune. In today's video, we'll shine a light on what the 13F shows us about the investments of this company, as well as their current holdings and likely expectations about where future growth will come from. Coming up today on Finance in 5. So if you look at this most recent SEC filing, it's interesting, but it actually shows us all of the SECs that were filed since November 2013. And I've actually worked out here that what's happened in the 7 years and 2 days since the first SEC filing, when he had just about $5 billion here that you see on the bottom. And if you look at the column to the left of that, about 36 stocks. Now he's got 90 stocks and 36 billion. Well, as I was saying, in that time, in 7 years and 2 days that have elapsed since that first SEC filing on the bottom there, Chase Coleman has made, through this fund, $29,562,822,000, and that comes from deducting this top figure off the very bottom one. 29.562 billion. Divide that by 7 years, that's 4.2 billion a year. Like many fund managers, Coleman has diversified the holdings of Tiger Global Management in order to gain exposure to diverse sectors. We can't possibly go over 90 shares in detail today, but we can absolutely gain some extremely useful insights. Check this out. So one of the things I like to do when reviewing 13F filings is immediately to look at the far right-hand side column, because this column shows you the percentage change in holdings of the stock in question since it was first purchased. Therefore, the higher the number, the more shares in the company the fund manager has decided to buy later on. And look at this huge number, 775.08. He invested in a company here called Phoenix Tree Holdings Limited, and he's really boosted his position in this company from $17 million to $149 million. Now, what on earth is Phoenix Tree Holdings Limited? Well, it's a Chinese company based in Beijing that handles the renting of rooms to residents. It's not a typical renting company in that, according to this, it works with landowners to set up individual rooms as apartments through its Dank apartment division. So this company offers dormitory-style apartments to businesses. It launched its IPO in America in the first half of 2020. It uses artificial intelligence and its online platform to take the hassles out of renting for renters and for the apartment owners themselves. Its growth is concentrated primarily across a small number of population centers throughout China, including Beijing, which has 21 million residents approximately. The rooms are quite nice and orderly, and because of the fact that China has an emerging middle class with high levels of, or growing levels of disposable income, it's possible that these rents are going to increase in value over the coming years. We look as well at the number of actual apartment listings that are going up. It's increasing. So the more renters or residents that you have, the more quickly the mortgage principal payment gets paid down and the more profit for the company. So it looks like it's expanding, which is good. It is a Cayman Islands incorporated company, so some people might be concerned that it doesn't have the protections that are the same as it would have if it was a US domicile company. Having said that, it may be able to expand more quickly and return more money to shareholders owing to the 0% income tax status of the Cayman Islands, unless of course that gets overhauled by an incoming Biden administration. So it looks as though the market has beaten these shares down and they look almost like roadkill at this point. I think you can pick up shares in Phoenix Tree Holdings Limited for $3.31, which is cheaper than what Chase Coleman himself bought them at. And given that many analysts think that this company eventually could reach a share price of in excess of $25 per share, maybe now is not a bad time to pick them up. So the model is all about using technology to make things easier and better for renters and for landlords at a time when the number of people renting in China is going up and the compounded annual growth rate is increasing 10% year on year, and that's expected to continue between now and 2023, if not beyond. This company saw a tripling of its revenue in its top line in 2017 and 2018, and its shares are cheap at the moment. The other important thing to realize as well right now is that this company is likely to continue to do well because people are paying more in rent on a monthly basis in China as a result of the continuing expansion of the Chinese middle class. So that is going to really lead to an increase in Phoenix Tree's revenue, which will continue beyond 2023, according to many analysts. So this is why this is a popular company for Chase Coleman. So anyway, let's move on to JD.com. He's got huge amounts of money in JD.com. I think it's over $4 billion. So now we've got a look here on this chart at the share price. We can see it's climbed massively from just over $30 up to right now where it sits at $88.23. So this has already been an enormous rise just in 2019 and 2020, but predominantly in 2020. So this really gives us a clue that this company is doing particularly well. I'm just looking at Seeking Alpha here, just clicking on the earnings. As we go down this chart here, I mean, it says that the value isn't particularly good, but just in terms of the earnings, this particular company outperformed its targets consistently. Look at how much more it's outperformed its targets by recently as compared with previous quarters. 1.6 billion, 1.3 billion, 682 million. This is really absolutely on fire by the looks of it in terms of profits. And we look here just at the ratings. This gives us some clue. The green dots, that shows people who, or analysts who are extremely bullish on this company over time. And even now at these high valuations, there are people who really do believe that it's going to continue to do well. So what are some of the reasons why JD.com Inc. is doing so well? Well, again, it's another Chinese company. And this is very much, are you noticing a pattern here in Chase Coleman's investment philosophy? And it's owned and operated by its founder. And according to this analyst, he says that that is a recipe for the founder being intent on growing the revenues of the company and sustaining that over a prolonged period of time. And we noticed this is an excerpt from an earnings presentation given earlier in 2020. It shows us that there's been a consistent increase in operating profit and margins over time. And this is a quote which really stuck out to me, where he says, "Only once Amazon's scale is such that it brings in more than $59 billion over a 90-day period will its operating margins be as attractive as JD.com. And we all know that the basic thesis behind Amazon is that even though it continues to lose money all the time and it operates at such razor-thin margins, it's able to just offset its losses and continue to reinvest in growth and outpacing its competition, so it doesn't really care. Alibaba trades or is available to buy shares for at 5 times its 2022 revenues. Amazon trades for 4 times its 2021 revenues, and JD.com is only 1.1 times its forward sales. So that means it's not an expensive multiple and it's cheap to pick up. So this essentially is a really undervalued company compared with all of the massive volumes of cash it continues to generate on an unfettered basis. Microsoft. Let's talk quickly about Microsoft, because this is another position which is prominent in Chase Coleman's portfolio. Now, we've talked before a little bit about Microsoft. When we mentioned its profit-sharing agreement with GameStop earlier in a previous video, it's also releasing 2 versions of its Xbox console in order to reach as many people as possible, apparently. This analyst, thinks that Microsoft is going to be the best performing stock, big tech stock in 2021. And he gives a number of reasons for that. He talks about how the fact that Microsoft offers a lot of different options for customers in terms of ways of generating revenue for them, because it's segmented into a number of key distinctive business arms. He talks about how Microsoft has got historically high levels of performance and reinvestment of its capital into improving its operations. And it also talks about how other tech stocks have dropped as well during this time. So when we look here at Microsoft, it's got all these different sections, different segments. We've got the Microsoft Cloud Computing and the other Microsoft Teams, which is obviously very popular during this year, and a CEO who has massively improved the top line at Microsoft since he took over in 2014. The other thing as well is that because there are so many different arms to this business, it doesn't matter if all of them aren't excellent. 1 or 2 can be middle of the road, but if the other ones make up for it, then fine. So going by the last few years' performance, you can be reasonably confident that you're going to get a good return if you buy Microsoft stock. The only downside is the initial cost of acquiring it, which is quite high at the moment. Next, Sunrun. Now, I've focused predominantly here on companies which Chase Coleman has got really big positions in. Sunrun basically provides and services solar power, photovoltaics, solar power, batteries, all of these other things. We've got an article here talking about how this company is doing really well. It's continuing to grow. And that growth is happening reasonably quickly in places like California, Washington, and Oregon, where there have been these wildfires cutting off power supplies to homes and to families, and where also there's quite a lot of natural sunlight every day. Obviously, this company probably wouldn't do that well over here in Europe, where for the most part we have about 19 hours of darkness a day. But here we've got news about how this company is going to do well because of the fact that the market for solar plus storage systems is going to grow sixfold through 2025. And, this is because of firestorms ravaging out California. It talks about how the company is supplying lots of solar capacity to different houses. And the other thing as well is the fact that these systems need servicing once they've actually been installed. So a new battery might need to be supplied every few years. And according to this, there's going to be pent-up demand for goods and services when the economy unwinds. People are going to want to be prepared for such events as wildfires or disconnection from power grids in the future. They're actually going to want to have a ready supply of solar energy at their homes. A lot of people are buying now solar-powered lights that they can use outside that can charge during the day. Finally, CrowdStrike. I don't know if you've heard of CrowdStrike, but it's a really powerful company which is growing extremely rapidly. So what CrowdStrike does is it protects or helps to protect small businesses from the threat of what it says here are bad actors or data security breaches or hacks or cybersecurity problems. Usually these can cost businesses a lot of money, so CrowdStrike's offering is actually very attractive to them because it doesn't cost much, but it saves them a lot of money. So the business model, there are a few different subscription models that CrowdStrike offers here to businesses, and businesses can incorporate more modules or reduce them down depending on their needs. And here we see a graph which roughly plots out the likely growth path of this particular market over the course of the next few years. We can see that it's going to be going up billions, and this is where CrowdStrike come in. This is a massive thing. Cybersecurity, which is outsourced by small businesses to third-party companies such as CrowdStrike, is, according to these projections, going to increase considerably. CrowdStrike has already gone up in value during 2020 over 130%, according to this chart. It looks likely to capture more market share. And I actually think this could be quite a clever move in view of the fact that so many businesses now have to move online because they can't operate within a retail environment or space owing to these lockdown restrictions. So what are they going to do? They're going to want to have security protections, and this is really quite a clever move. I think that CrowdStrike could continue to see upticks in its valuations over coming years. So well done, Chase Coleman. Those are just a few shares that he owns, just to give you a flavor. I haven't gone over them all. There's not enough time. But I do hope that you enjoy this video. I'm going to try and get more videos like this to you about what the big dogs of the investment world are choosing to invest their billions into. If you've got any particular requests, keep them coming. Let me know. Write some comments below. I appreciate you watching these videos, and very best wishes for the rest of today. Have a great evening, and hopefully we'll speak soon. All the best.